Hello, everyone, and welcome to today's discussion on the digital asset landscape. This topic could not be more timely. To say that interest in digital assets has grown is a gross understatement. In the past week, the global market cap of cryptocurrencies passed the 3 trillion mark, surpassing the GDP of the UK and comparable to nearly 25% of the global market cap of the gold. Stablecoins, central bank digital currencies, and tokenization of a wide range of assets has also emerged to populate the digital landscape. By October, more than 130 billion in stablecoins had been issued. Financial institutions are recalibrating their offerings to meet client and investor demand, while regulators are trying to keep up with innovation, much of which is coming from outside the banking industry and not addressed by the existing regulatory framework. Meanwhile, the digital ecosystem has evolved at a different pace around the world. Asia has moved quickly ahead with digital payments and an e-currency launch in China, with already 5.5 billion in transactions cleared in digital renminbi. Europe has moved quickly and some would say ambitiously on the regulatory front, while in the US, a dynamic private sector has spawned focusing on digital assets, and finally, work has begun exploring a central bank digital currency. At the same time, many emerging markets and the large population of the unbanked, which is calculated to be around 1.7 billion, are still looking for cheaper, more accessible, and faster means of payment methods. So to discuss this multifaceted and rapidly evolving topic, we're very pleased to welcome a distinguished panel of speakers today. I'd like to introduce Ben Pott, who is Head of Public Policy and Government Affairs for EMEA at Bank New York Mellon. Matthias Studak, who's CFO of SDX, a blockchain digital asset exchange, and Co-Pierre Georg, member of the Economic Advisory Committee at Algorand, and also chair of Research and Financial Stability Studies at the South African Reserve Bank. And I am Patricia Haas-Cleveland, OMFIF president in the US. So welcome, everyone. In this hour, we will ask the panelists their views on the digital landscape and regulation, innovation and challenges, and look ahead. After the panelists speak, we'll open the floor to questions. So please enter them in the chat box and we'll be happy to call on you. To begin, let's start with a quick overview. And for that, I'd like to turn to Co-Pierre. In addition to serving on the Algorand Foundation, you're also a professor teaching courses on fintech, blockchain, and digital assets. So perhaps you could give us a bit of an overview quickly, how you would classify the different digital assets shaping the digital landscape and their use cases. And also, I notice you are launching a fintech innovation hub at the University of Cape Town. Perhaps you could tell us some of the issues you're trying to tackle there.
Yeah, thank you so much, Patricia. I think so if I had to summarize it in one word, the summary would be changing and rapidly changing. When we started our master's in financial technology at the University of Cape Town 4 years ago, the program was really focused on what I would now call private crypto assets. So your traditional Bitcoin, Ethereum, the public permissionless blockchain protocols and their native tokens. And that was nice and interesting. People started to get sort of involved in the space. Students were very excited about this rapidly changing landscape. And as time went by, I think we saw the emergence of sort of big tech companies moving into finance. Notably, Facebook with Libra making the announcement that they want to be a global stablecoin. And I think this really was a watershed moment for regulators. At the time, regulators were caught a little off guard. And suddenly they realized there is this huge new asset class called a private stablecoin that could potentially overnight service 2 billion customers globally, have a reach that far transcends national boundaries. And that is very difficult to regulate. So credit where credit is due. The moment that Libra was announced, regulators started to look at central bank digital currencies as public stablecoins, I would call the third type of asset class, with great earnest. And at the moment, we have way over 80 central banks worldwide looking into central bank digital currencies. In Africa, we have the eCedi and the eNaira that have launched or are launching. South Africa has done Project Coca as a wholesale central bank digital currency. to facilitate interbank trades in 2018 already. And the Reserve Bank has publicly communicated that they are investigating a retail central bank digital currency to broaden access. So I think these are developments that show that this asset space is moving from an unregulated sort of Wild West to a clearly regulated, clear boundary set infrastructure. And a lot of what we are working on in the Innovation Hub in Cape Town is centered around like, how can we create digital infrastructure for the next century? How can we make sure that this infrastructure is open and inclusive, and that we don't repeat the mistakes of the past where we had closed loop payment systems with insufficient competition, high fees, not ideal targeting of low income households? How can we make this system better? How can we ensure that the plumbing of the financial system is actually adequate to support the digital economy, where we will see a great variety of asset classes, from non-fungible tokens that can be from digital collectibles to digital rights tokens that include sort of the rights for digital objects. I think this is going to be a rapidly and massively evolving economy where we see very different kinds of assets that are traded on hopefully a well-regulated level playing field created by regulators.
And as you look at what you're doing and what you're seeing, what do you see as sort of the greatest challenges from your perspective?
I think the biggest challenge is technological, or maybe communicating the technology to regulators and supervisors. You're putting central banks in charge of building an infrastructure that doesn't exist in that form. And central banks themselves, since the 70s or 80s, when we started to create digital payments on large value payment system, they don't have that track record of building this kind of infrastructure from the scratch up, dealing with tech companies, dealing with startups. So there's an anecdote I like where a crypto startup was invited to present at the New York Fed, and the CEO wouldn't be allowed in because he didn't have a suit or tie or anything. It was a conference with the NY Fed president at the time, and the security just wouldn't let him in. So this just shows you the kind of culture clash that you can have sometimes. But it's really important that these two communities start talking to each other much more, because the technological frontier has shifted with blockchain and with all the innovation that followed. And regulators need to listen, even to the guys that don't wear suits and come in Hawaiian shirts to your conferences, because they can tell you about the possibilities and the challenges that regulators have to address if they want to safeguard financial stability and make sure that their control over monetary policy implementation remains superior, because otherwise all of this can get challenged.
Yes, you've probably hit already in the first 10 minutes of the panel one of the single most important aspects of this evolving system. It is the intersection of innovation and regulation and how they come together, and the catch-up that's needed to stay on top of what is, as you pointed out, an almost explosive ecosystem that's developing with innovation. And it can't be easy for a lot of central banks, because that's not the business they've been in the past, to have their own in-house labs and people doing this. But that's a great point, and we definitely want to come back to that. Let me turn to Ben, who is at Bank New York Mellon, which is obviously a global bank. It works across multiple jurisdictions, operating multiple businesses and products and services. So you obviously have to deal with a lot of regulatory issues all the time. So from your perspective, what do you see as some of the key challenges in terms of demand for digital assets and the pace of innovation?
Thank you very much, Patricia, and I hope you can all hear me right. I don't know why I'm having a little bit of internet trouble today. I hope the connection holds. So thank you very much for inviting me. Pierre already gave a great overview of the different types of assets, and actually the way you look at it from a regulatory lens is through three different lenses as well, which is one, how do you treat all those assets that fundamentally fall completely outside of the regulatory framework that exists today. The second one is for those assets that fall within the framework. So think about tokenized securities, for example. And the third view, really, as Copier has described it, the stablecoin and CBDC area. And I would say one of the key challenges for the financial industry is really understanding what legal and regulatory framework applies to each of them. When you think about the pure kind of crypto landscape, Europe actually has been fairly forward-thinking and coming out with a proposal for market and crypto asset legislative proposal, and that effectively would apply a complete new framework to these unregulated, or I would rather say those crypto assets that fall outside the legal framework. Now that's still in the making. So currently the European Parliament, the European Council are kind of negotiating around this legal and regulatory framework, and we don't yet know where that will end up. So some of the questions around how you trade those assets, for us in particular, how do you custody those assets? What liability is associated with custodying those assets? All those questions are still kind of up in the air. And as it always happens in a kind of EU context, you would then have individual jurisdictions who go ahead and create their own legal frameworks in the absence of having that European framework. And I don't have to explain it to you or people on the line. That's clearly quite challenging because you then navigate 27 different legal frameworks and regulatory frameworks that might at some point in the near future become redundant, because then you have the EU framework that sits on top of it. So that's clearly one challenge. And then you have the other challenge, which is kind of looking at it from a slightly different lens, which is those assets that fall within the regulatory perimeter. So tokenized securities. We have a very well-structured, well-regulated market for securities today. We have MiFID, which tells you how to trade those assets. We have an SFD, Settlement Finality Directive, CSD regulation, and all of these things kind of have created a fairly rigid framework around securities. So the question now is, well, you have these new assets that really work slightly differently to the traditional assets, and actually that legal and regulatory framework doesn't really fit that well anymore. So what do you do in the absence of reviewing all these pieces of legislation, reviewing MiFID, reviewing CSDR, reviewing the Settlement Finality Directive? Well, actually, you create a pilot regime, which is what the EU is currently doing, which effectively allows on-chain issuance, settlement of these kind of tokenized assets, tokenized securities that would otherwise fall within these existing legal frameworks. So that's what the Commission has put forward. Again, it's a pilot regime that's not yet finalized. We're still in negotiations. We're hoping that will go live at some point in 2022. But there are other challenges associated with that pilot as well, which is, what happens when the pilot comes to an end? What comes afterwards? They're quite limited around how much you can issue through this pilot, how much trading and settlement can happen within the kind of pilot regime. So there are some size limits as well. So all of these things make it fairly challenging for the industry to kind of navigate the landscape. But I'll probably end there. I'm happy to talk further.
No, that's a great point. I was going to ask you to turn to Europe in particular. I mean, some people have said it's amazing how fast Europe has moved, and perhaps, very ambitiously going from zero to MiCA in 2 years. And obviously there is the challenge that you have something at a sort of pan-Europe level, while at the same time you've got things going on at the national level in different jurisdictions. I mean, we've seen progress in Germany with BaFin. Switzerland separately over here has moved ahead with a blockchain act this year. And so it is complicated to sort of be moving both at a pan-European level and at the same time within jurisdictions. So I don't know that there's any easy answer for this. And I think one of the last things you said is perhaps one of the most important, which is it's hard for regulation that comes out sort of as innovation is developing to be sure that it stays one step ahead of innovation, or at least allows for innovation to continue. Do you worry that some of these regulatory moves, even though they're ambitious and they're lauded for being at least trying to deal with some of these questions, the gaps in MiFID, but do you worry that they could stifle innovation unintentionally?
I would probably actually say maybe the glass is half full rather than half empty, in the sense that, in the absence of having that pan-European legislation that tackles all the different issues up front and gives us that 100% certainty, I guess the advantage of individual jurisdictions moving ahead is they are able to move a little bit quicker, and that does create a framework where smaller firms or even larger firms can at least start off providing some services in that jurisdiction. So I wouldn't see it completely negatively that we haven't got that kind of all singing, all dancing European framework. Ultimately, I do think it would be beneficial for Europe to have an existing legal framework that can effectively create that pan-European framework and allow passporting of services from one jurisdiction to the next. But we've seen in some European member states that they have been quite successful in creating their own regimes which provide certainty. In Germany, they have a crypto custody license, for example. And the same in Switzerland and the UK, who are outside of the European Union, but clearly they are also developing their own frameworks. And I think for local market players, and that's really important. Why is that important? Because the worst is actually working in a vacuum of legislative and regulatory requirements, not knowing if what you're doing kind of fits the risk appetite, frankly, of the regulators and the supervisors. That's worse than having a regime that might not be all singing, all dancing, provide you with access to all the different markets across Europe, but at least it provides you legal and regulatory certainty to operate in that jurisdiction.
Yeah, that's a great point. I mean, if you look in the US right now, one thing that you hear a lot from the crypto community is not that we don't want to be regulated, it's we just want clarity. We want to know what we can do and what we can do. So that's a different story, but it goes to your point. That's great. I'd like to turn to Matthias Studach. Staying on the theme of regulation, but also innovation. SDX is a blockchain digital asset exchange, and you recently received 2 regulatory licenses. Can you tell us what they're for and why they are important? And also, your initial focus has been on Switzerland, but blockchain digital assets, they're obviously expanding across jurisdictions around the world. And maybe you could also comment on, from a regulatory perspective, how you see this and how important, for instance, is harmonization and standardization when you're looking at definitions and rules.
Yes, thank you, Patricia, and thanks for having me here today. I would like to give you a quick background of SDX. So SDX is, as you said, is a fully regulated digital exchange for trading, settlement, asset servicing, and custody of digital assets. This year in September, we received 2 FMI licenses from FINMA, that's the Swiss regulator. The two licenses include a stock exchange license and a central securities depository, a so-called CSD license. So on the one side, the stock exchange license enables us to list and trade security tokens, and the CSD license, on the other hand, allows us to operate a security settlement and custody system, which runs on a distributed ledger technology. So it's I would say, so-called distributed CSD. With these 2 licenses, we are able to cover the entire FMI value chain. So from listing, trading, that's the stock exchange part, to settlement, asset servicing, custody, and on-chain cash settlement of digital assets. The initial product scope of SDX will include security tokens, and in particular, these are digital bonds and digital equities. So we support both private placements and also secondary market trading. And I think important, these 2 licenses allow us to engage with regulated financial institutions. That's primarily banks and security dealers. So we can't, and we're not allowed from a regulatory perspective to directly engage with end customers. So answering the question in short, these 2 licenses are actually the foundation of our business model to trade and settle security tokens. Now, the second question was around harmonization and standardization of legal and regulatory frameworks. How does that affect SDX? Again, I want to start at the beginning. SDX has been a front runner in the space of security tokens in 2018, and we faced a lot of, maybe not only regulatory challenges, but a lot of challenges on our journey from the inception to where we stand today. But since the very beginning, we did closely work together with the Swiss regulator and also the Swiss National Bank in defining and implementing a solution design for security token, which is in line with the existing law and regulations. So we couldn't change the law and the regulations, so we had to make sure that our solution design is actually adhering to existing law and regulations. And it was actually not that hard. I will come back to that later on. So we have been able on this journey over the last 3 years to address all relevant questions with the Swiss regulator as the basis to receive these 2 licenses. I think most importantly, from a regulator perspective, but also from an STX perspective, the interpretation of the law and the regulation shall be technology neutral, wherever possible, and the same applies with the look-through principle. For example, why shall a security token, so a security which is being stored and settled on a blockchain, why should that be treated differently from a legal, regulatory, or tax perspective compared to traditional assets? I think that's always the view we had together also with the regulator, and with that framework, we actually could achieve the licenses within reasonable time. So the setup provides legal and regulatory certainty in Switzerland for Swiss banks, for Swiss investors, for Swiss issuers. This is key for the trust of institutional players, and also builds the foundation of a successful business model. However, when we want to grow, and that's clearly an ambition, our business model globally, we need to get the same clarity on an international level. Currently, and we heard that from Ben and Pierre, there are many initiatives on different levels like ongoing to define a framework for digital assets. This is in my view the right direction, as legal and regulatory clarity will help to grow the business. But it will be important that these initiatives are harmonized and international standards will evolve for digital assets. Because one of the main promises of distributed ledger technology is that it can make cross-border transaction faster, more efficient, and cheaper. And in my view, this can only be achieved or take place if the same rules or harmonized rules and standards apply across borders.
Yes, and I think your case is particularly relevant given your journey to get these 2 licenses entailed working very closely with the regulators and having this dialogue which can help inform and sort of shape how they evolve their laws. And in your case, or in the case of Switzerland, this was quite effective. And I guess to some extent, Switzerland's been quite progressive in how it's looked at innovation from a regulatory perspective. But do you think your case with SDX and working with the Swiss National Bank and regulators is a good template and can be achieved in other countries? Do you see this happening in other countries and in other cases?
Certainly. I think I want to bring up a second example. That's not the Swiss regulator. That's the Swiss National Bank. SDX and the Swiss National Bank has started a collaboration early in 2019. That's the collaboration is called the Project Helvetia, and we jointly explored technical and operational possibility to settle digital assets in central bank money. And the first phase, which was conducted last year in 2020, was at least to our view a large success, and the results are publicly available. There are even short videos on YouTube which you can watch. And we're now entered in a second phase of this exploration, which is focusing on an end-to-end integration of wholesale CBDC, which is being issued and settled on our test platform, so the STX platform, and is being then reflected in the core banking system of the Swiss Central Bank and also commercial banks. So that the focus has widened to an end-to-end view, and we are about to publish these results very soon. And a similar experiment is currently taking place in a cross-border setting where the Swiss and the French Central Bank are involved, including a number of commercial banks and also technology providers. So I think there is a lot of momentum in the market, especially also on the CBDC side, and your question was around whether that's a template and what are the benefits of having these private public collaborations. I think in my view, they're important to learn from each other, but also to benefit from each other, to increase realism in such experiments. Ideally, we go as close as possible to production and using real value transactions, because that makes everything much more real. And I think from a country perspective, from a jurisdiction, it's important to remain competitive as a marketplace. So such collaborations help actually to remain competitive and stay ahead of the curve.
Yeah, absolutely. I'd like to take a step back now and turn to the question of sort of financial stability and innovation. And maybe for this, I'll bring back Co-Pierre. You've written and talked a lot about this. And when we think about it, regulators and central banks have as part of their day job, obviously, or most of their day job, is to really worry about financial stability. So how do you see the intersection of financial innovation and financial stability developing? Are we going to be able to have this sort of traditional world of traditional banks and payment providers coexisting with the new DeFi world of money and digital assets? Will they go on separate parallel tracks, or will they intersect? I think what everybody I'm hearing saying is they're going to intersect, but maybe you can elaborate a little bit on this, and particularly from some of the work that you're doing on financial stability with the Reserve Bank of South Africa.
All right, thanks. Yeah, I think that's a really important discussion that is currently ongoing on the regulatory side. When you look at the market cap of crypto, you said it passed 3 trillion yesterday. I guess 2 days later, it's at 2.5 trillion, given what has happened in markets lately. There's a lot of volatility. Just as a comparison, the number I found for the total losses globally from the global financial crisis through to subprime mortgages was around about 4 to 5 trillion US dollars. So we're starting to get into a region where the amounts start to matter for financial stability. Now there's sort of lots of differences in terms of who holds private crypto assets, even if institutional investors are getting more active in the space. And I think what Matthias sort of elaborated on is one of the reasons why they can, because the exchanges and the infrastructure for the digital economy is becoming more regulated. It's sort of getting more integrated with the legacy, quote unquote, financial system. And that just provides a bridge for those institutions to get involved. The difference is that they are mainly getting involved on behalf of their customers. Only to some extent, I think you're seeing them getting involved on their own accounts. And I think hedge funds, sure, they're first out the gate always. Banks will take a little longer before you see sort of large adoption. But there's great benefit for financial institutions to become involved in the digital asset space. When you look at the growth of the digital economy over the past 10, 20, 30 years, you see that it outpaced the real economy. Actually quite significantly in some years. So it means that the total share of digital services and goods as a percentage of GDP has been increasing. So it means the digital economy is becoming more and more relevant. If as a regulator, you want to ensure that you can implement your policy, be it policies to safeguard financial stability or a level playing field or just monetary policy, you need to make sure that there is an infrastructure in place that can facilitate new business models through tokenization and things like that. Now, for banks, there's a real risk here at the moment. The risk is that they are missing the train, and that they remain sort of in the legacy world with more than one leg for too long, and that you have less or unregulated tech companies come in and take away their lunch. In payment services, which is one of the main sort of sources of revenue for most banks, you face an immediate, imminent threat from even small startups. It used to be 10, 20 years ago that you needed 50 million euros and lots of regulatory approval to start a bank to be able to offer these services. Now, all you need is to know someone who can code. It's a significantly lower threshold to start entering the space and target specific markets and become disruptive. And banks are at the risk of being disrupted by this. And while some of them embrace this on paper, more or less, I think real sort of endorsement and real transformation is not yet happening in the banking sector at large. And then the same risk applies to regulators. Stablecoins have the potential to challenge the supremacy of monetary policy. They have the potential to challenge monetary authority. So the question then is, how can you deal with that? With Libra, there was an immediate sort of agreement that this is going to challenge global financial stability. So the G7, in a rare agreement between the Trump administration and a social democratic German chancellor, everybody came together and said, well, this needs to be happening within a regulated, well-regulated framework. FINMA and FINRA were very active because Libra was seeking license in Switzerland, which they didn't get. So I think that was a case where the regulatory landscape came together quickly. Now we are at a risk that we don't see the same sort of urgency happening when it comes to national stablecoins. In every country, you'll have stablecoins, private stablecoins issued by unregulated entities now. So these tend to become the on-ramps for the DeFi space, and they tend to replace the traditional on-ramps, which are our banks. And there is a real risk to financial stability if banks don't adapt to this quicker, and or if regulators miss the boat and don't provide this infrastructure for banks to be able to be competitive with the tech companies that come in having a substantive data advantage and informational advantage over our existing banks. So I think it's very important for regulators to realize this threat to the banking system as a whole if we don't provide them with the tools to be able to offer these new goods and services to a changing customer base. And I think that's sort of the discussion that is happening both on national levels as well as in international fora around financial stability when it comes to fintech. It's not so much that Bitcoin might disrupt the financial market. I don't think that's a risk here.
So is it a bit of a chicken and an egg? Is it that the banks are just saying, I'm going to stay out of this, I don't understand it? Or is it that they are trying to enter this space and there's pushback from a regulatory perspective? It's probably a little bit of both. Some are still staying out and realizing I got to get on board the train, where others are on the train. Where do you see this from a chicken and egg perspective?
I think it is banks staying out of it partially because they have to be compliant with existing regulation, while these small startups don't really, or there are exceptions, there are sandboxes. There are lots of ways to sort of get around this. They do try though, so it's not for lack of trying. And all banks have some fintech innovation program internally now, and a lot of that is sort of nice brochures or nice websites, and maybe they're buying up a few smaller companies here or there. None of that is preparing them for the threat of being the small fish in the pond. How does a bank like BNY Mellon, how do you plan to compete with a company that has 2 billion customers and more cash than your market cap? How do you want to compete with that? It's a real challenge, not just to one bank. It's a challenge to the entire sector. Countries like China have sort of found answers to this question. They said, we provide the DCEP, the digital currency project in China, we provide an infrastructure on which we create a level playing field, a marketplace where everybody can come together. Now, the vision for Algorand is that such a marketplace needs to be open and global and interoperable, but it needs to be a marketplace where everybody can come together, as opposed to sort of closed loop payment systems, which is what these stable coins are trying to create.
Yeah. I definitely want to go to Ben on BNY Mellon. They're a very interesting case in point because they've really embraced the digital landscape. But before I turn there, let's just stop for a second on central bank digital currencies, because maybe this is kind of an in-between. We talked about the whole payment situation, and we know that Libra really started out, or now DM, to solve a payment question, because we do have these unbanked all over the world. It's very expensive. It costs, it takes time and efficient to send money over borders, remittances. So, and now we have stable coins, we have a lot of these other developments, but what about central bank digital currencies? Are they, is this a possibility where you can get the regulatory world and the innovative world to solve a problem around payments? How do you see that playing out?
Oh, we see that already in some of the discussions in South Africa, but also in other African countries. You do see a big focus on financial inclusion and the enabling potential of central bank digital currencies for financial inclusion, because financial inclusion is first and foremost not a problem of people not having bank accounts. It's a problem of people not having credit history. They don't have the ability to take their credit history with them. So in a lot of the discussions that Algorand has been involved in, it has always been sort of a prime focus. How do you get access? Now, the main challenge is 3.6 billion people globally don't have smartphones. So the whole crypto spiel doesn't work if you don't have a smartphone. So one of the focuses of our work, both at the Innovation Hub in Cape Town, but also for Algorand, is to bridge that gap and to find alternative ways to get people without smartphones access to digital assets. And they do exist, and they are being embraced very actively by regulators, because if you want to create a universally accepted digital currency, well, you need to make sure it is universally accessible.
Exactly. Yeah. Okay, Ben, we're coming on to you because you are at a big global traditional bank and one of the oldest, set up by Alexander Hamilton back in the 1700s. Meanwhile, the train is moving at a very rapid rate on digital currencies, digital interest. Copierre mentioned hedge funds. There was a report the other day that said that hedge funds were going to put as much as 7% in their portfolios and in the crypto space. Fidelity came out with a report over the summer that said that 7 out of 10 institutional investors plan to add cryptocurrencies and digital assets to their portfolios within 5 years. So there's this huge interest and there's this huge demand. So from your perspective as a global bank, what have you all seen in terms of client interest or customer interest, both at the institutional level and the retail level? And how active are you in this space? What is Bank New York Mellon doing?
Thank you, Patricia, and thanks for allowing me to respond to Copierre. Clearly, we've been around, for a long time, as you said, the oldest bank. So we had to go with the times, and the same is true in the digital asset space. And we've been very public about the fact that we have a kind of holistic digital assets unit that really looks at all the various different developments that we have discussed here before. And really, again, kind of responding to Copierre's point, I think it's really critical here that we build secure infrastructure for clients to transfer, to hold and safekeep and issue these digital assets. And that's kind of what we're out to do. And as I said, we've been very public about that. But let me also make the point that actually, different clients have different demands here. And, focusing, for example, on the CBDC debate, is quite interesting how even different central banks have looked at the CBDC debate through different lenses. Some are looking at this through the retail lens, the payment lens, and Copierre has described that. Others, and Matthias has described a little bit in what they're doing, are looking at this more through the wholesale lens. So, even on such a straightforward might be the wrong term to use, but even on the topic of central bank digital currency, where you have a kind of limited number of actors, even there, that very different approaches from one central bank to the other. And again, I think when you look at the retail space, clearly there's a huge interest in crypto. I would argue that varies as well by region. So, for a global bank, it's not always a one size fits all approach. You need to understand what your clients are most interested in. Clearly in Europe, we've seen a number of jurisdictions really focusing in on the technology aspects rather than the digital asset aspects. So, Luxembourg came forward with a blockchain strategy. How do we enable different clients to issue on a blockchain? And I think, our challenge as BNY Mellon, but also as an industry as a whole, is to kind of put our arms around all these different developments from a legislative regulatory side, from a market side, understanding what solutions the clients are looking for. So, yes, it is a challenge, but it's not the first challenge we've come up against. And yeah, we're embracing it, and we're trying to build trusted solutions for our clients. I think that's ultimately where we're going.
So you would say you're definitely a case of a traditional bank that does not want to be left behind. and is embracing it. So is it, from your perspective, I would take it you're seeing that digital assets are indeed becoming part of mainstream finance, and you're positioning yourself to sort of handle your clients' and customers' interests from that perspective.
I would actually say, we don't want to make a judgment on which digital assets are going to succeed or not. But if there's client demand for an infrastructure to service those digital assets, we want to be the one providing those solutions.
Yeah. Matthias, let's go back to you for a second as a practitioner on the ground, innovating and dealing very much in this live environment. If digital assets do in fact become part of mainstream finance, what are the remaining challenges? I mean, we talked about from your perspective, we talked about the regulatory importance of sort of alignment and being able to work across borders. But would you say that's the main one? Are there other challenges from your perspective that I mean, obviously there are other challenges, but how would you sort of prioritize the top 2 or 3?
Yeah, I mean, exactly that legal and regulatory clarity. I think that's only one element. I think it's very important to recognize that the financial industry, its technology and processes have been built, evolved over decades. And now transformation to a new technology, to standards processes will take a long time. So we see there are multi dimensions. It's technology, but it's also processes. It is standards which need to evolve. And I think another important element is benefits of the DLT technology are often not immediately available, and a positive payback often will take several years. Therefore, in my view, the adoption will be very incremental in the traditional space, and we heard that before from Pierre that it is much easier for startup fintechs to actually get out to the market with something very innovative. For banks, it's for established institutions, it's much harder. A big bank doesn't work. I like the terms of lag and legacy. So they have legacy systems, and they can't just plug and play. Maybe they can't plug and play, but plug and play means, okay, we have another system, and just adding on top DLT is not solving for a problem. It's even creating an additional problem because there is an additional reconciliation required. So in my view, it takes time. I think that's the core message, because there are multiple dimensions, and one of them we discussed, the legal and regulatory clarity, which is clearly the foundation.
Yeah, absolutely. We have a lot of questions starting to come in, so I'd like to turn to those so the audience has a chance. So here's a bit of a specific question, but it goes to the heart of some of the regulatory issues. Who will oversee the identities of both the crypto wallet and its owner? The exchanges and brokers do not seem like effective gatekeepers. I don't know that falls in anyone's particular wheelhouse, but you all have a great perspective. So, Pierre, do you want to kick off on that?
Yeah, because it's actually something that we've discussed with several central bank digital currency projects around the very closely related to the issue of privacy. How do you ensure privacy, which actually came out as the #1 topic by the ECB survey regarding the digital euro, as the surprisingly overwhelming majority of people said they are concerned about privacy in a digital euro. So how do you ensure the privacy of users in a system while at the same time providing auditability for KYC purposes? One design that facilitates that is to actually have payment service providers who onboard customers collect the personal information, but wallets themselves shouldn't have any personally identifying information, so that in case there comes a query about a dubious wallet, you can send it to the right PSP, but the central bank, they don't have a central register of identities, which carries all kinds of cybersecurity risks. It carries all kinds of questions around whether central bank authority. Why should the central bank see who transacts how? So a system like that doesn't give you the same level of privacy that cash does, but cash is not perfectly private because each node has a serial number, so you can trace it. If you really want to, you can trace it. So like getting that trade-off correct is is a challenge, and the identity question is really the main key here. I think decentralization has been a very good guidance principle in the evolution of this space, and we should embrace it when it comes to identity.
Yeah, we haven't even really touched on identity, but that, I think, in sort of CBDC's 2.0, or even before you get there, digital identity is going to be really a very key point. Does Ben or Matthias want to add to that, or I'm happy to throw a few more questions your way, because we've gotten some specific ones in on SDX. So maybe I should turn to Matthias. Here's something rather specific. The exchange of collateral and margins with CCPs and exchanges is not usually done in central bank money. Would SDX, for instance, operate all payments in central bank money and eventually CBDCs?
It's a good question, and the question is whether there is a private institution who is operating a payment system for a central bank, and that's what we have. I mean, maybe a little background. Switzerland is probably an exception, because today it's already the case that a privately owned company is running the RGS system in Switzerland for the Swiss National Bank. I mean, that's what we have done with the SNB on the CBDC side. We have leveraged our CSD, so the security settlement, but also payment system, to issue a CBDC and provide the central bank the necessary controls that they feel comfortable that only they can issue central bank digital currency in our environment, and they can control flows in a way that they can make sure that each transaction which is being handled in central bank money, that they can release. But that doesn't necessarily mean that they see the end customer or any details. It's more a validation that the transaction is including CBDC. And we have even gone a step further, because I think we heard that before, that CBDC or DLT is only adding value if we can break down silos and create a global network. And so what we have done in the cross-border experiments with the two central banks, so the SNB and the Banque de France, we have built a network on a single infrastructure, giving both central banks the necessary control. I think that's is one step in the right direction to actually leverage the benefits of the DLT. I hope that answered the question.
Yeah, and one other question that's come in for you, Matthias, and that is, actually it's just disappeared, but I think it was basically, when are you actually going live now that you've got these licenses? That was the question.
So when we go live, so we got the licenses in September, and we are actually we have onboarded initial clients, and we are about to go live. And going live means, yes, we need to have assets in our platform, and they need to be transacted. And I can tell you that's going to happen this year. So we're all excited to see that moment.
That's great. I think all eyes are going to be on you, given the work that you're doing in this space. Okay, here's some questions coming in on crypto. To what extent are crypto assets additions to traditional investment activities, or do they offer something completely different? I bet there's a lot of different answers out there for that. Who would like to tackle that? Kopir, you have a big smile on your face.
Yeah, but only because I'm super biased on crypto, not pro, despite my work for Algorand. It's very tricky. There are some private crypto that provide utility and value. For the most part, I've always seen this as pure speculation. And if my students ask me, should we invest in crypto, I always give them a stern no. You should not, especially not when crypto hits towards all-time high. But I'm particularly sort of skeptical about this for a variety of reasons. There are some protocols where the technology itself that has been developed in the protocol has use cases that I think create fundamental value. Where smart contracts, not to pick something outside of Algorand, that I think as a commitment device, to be able to commit to certain actions and not being able to deviate from that, that's something that has plagued finance for many, many years. And where previously you only had sort of trusted institutions to actually do this. Think about escrow accounts. Now you can set this up in a much more sort of casual way with much lower cost. I think there's real value in that. Whether you need to run this on a public blockchain, but I think the number for Bitcoin that I saw the other day was that each Bitcoin transactions creates as much electrical waste as throwing away 2 iPhones. Now, it's completely unconscionable to do that. So what I think, again, super biased here, what I think is much more valuable is to take that technology, create the right setup between sort of the entities that have an interest in running the ledgers, and then use the functionality that the technology gives you to actually implement these use cases.
Right, and in some ways you come to the heart of the question. I mean, when we go back at the very beginning, when Bitcoin came about, it was really all about being outside the financial system, because it was in the midst of the Great Recession in 2008 when Bitcoin first emerged, and it was a way to be not part of that blow up. Looking then back, as we said, towards Libra, it was a payment solution. So one was to be outside the system, one was to be a payment solution. Now you have a lot of different purposes out there, but there's still a group of people who really believe in DeFi and who don't want to be part of the sort of centralized banking system. And for them, it's not just a speculative investment. It's really like, this is the future. So how do you, and I'm sure some of your students must feel like that. How do you answer them?
A lot of them. So I fail to see the true benefits of DeFi over a public infrastructure. I see the innovative potential and capacity. There's room to play and to innovate, and that's important. And nobody's going to dispute that. And there have been tremendous achievements from a technology perspective because it isn't regulated and it isn't sort of well provided. But sort of all the data I know on public crypto, wealth concentration is larger than in South Africa, which is the most unequal country in the world. So it doesn't do any good for financial democratization. You need a smartphone to access it, which means it's not doing any good for financial inclusion. DeFi is an amplification of this. And because a lot of the DeFi protocols are coupled together and uncoupled with underlying private crypto, there is huge systemic risk in that setting. There's sort of research coming out now trying to estimate the actual risk that sits in the DeFi system. And whatever sort of estimate I've seen, it is absolutely staggering, because at the end of the day, there's only so many off-ramps. If the SEC decides that all coins are securities, they will come, and Gary Gensler has commented as much, after the exchanges, and they will start finding the exchanges, they will start finding individual protocols, everybody will run for the exits. There's a traditional cash in the market situation where you see massive fire sales, and I think that risk is very real in the sector, and people do not internalize it properly. So yeah, the technology itself is innovative, but the risk that you are creating at the moment in that particular subsegment is absolutely staggering. I think the global financial crisis, in terms of its interconnectedness and in terms of its systemic risk levels, was nothing in comparison. And people don't really, and especially my students, they are not taking this into account. They're getting super excited. And I think Martin Wolf's adage of the four most dangerous words in finance are "this time is different," they truly hold here.
Yeah. But your students are the future, the next generation, so how they think is important. We have one last question and it's a big one, so I don't know how we're going to do it, although we've all touched on it. But going back to your point here on crypto, and it reminds me of both a quote from Kathy Wood at ARC, where she says Bitcoin can go to 500,000, and Ray Dalio Bridgewater said it can go to zero if the regulators come out against it. So there is this wide discrepancy, but it highlights the importance of regulation. Kind of to another practical question, cryptocurrency companies need to address the same risks as other businesses. What are the current challenges crypto assets, blockchain technology brings to risk management, and what decisions need to be made from a regulatory perspective? And this goes, I guess, both for fintechs and blockchain companies, but also for the larger banks like BNY Mellon, although you probably have addressed the risk management. I don't know how you've addressed it, but so maybe we should just real quickly touch on that before we close. Do you want to take a stab at that first, Ben, or turn it to some of your others who are really on the ground in this space?
Yeah, sure. I mean, it'd be interesting to hear from the others as well, of course. But I think what is really important to say is that obviously, if you operate in a regulated environment as we do, we apply our own risk frameworks to everything we already do today, right? So as we look at new innovation, the same risk framework would apply. I think what's really important is, and maybe kind of coming back quickly to Pierre's previous point, right? We talked a lot about what happens outside of the financial space, and within the financial space, I think the value of cryptocurrency and digital assets and digitalization as a whole will be in the use cases, right? So thinking about some of the challenges, smart contracts, for example, I think that might well be a use case that will come through to fruition that will be here to stay. The same about some of the transparency that DLT enables, right? The financial space in the past had very complex ways of turning on transparency. When you think about, previously I've always looked very closely at MiFID II, right? One of the big challenges there is how do you enable transparency in securities markets, right? So you have some of those use cases, I think, built in innovation and digitalization and digital assets that I believe will provide some benefits. So we talked a lot about the risks. So I think we look at the opportunities as well. Very specifically on the question you ask, absolutely. Ultimately, we all have to work with regulators, work with central banks to address some of the risks that we've debated here. Some of the big ones, the macro risk around financial stability, some of the I wouldn't say smaller, but significant risks around KYC, around AML that are already being addressed. And, clearly the review of the anti-money laundering directive and others are looking at that in the digital space. I think that's really important as well. And I think that's an industry challenge that's that for the whole industry. So yeah, we're not at the end of that process. I think it will be interesting to see how the whole ecosystem deals with these challenges, the financial space, the non-financial space, and clearly digital assets provide a new lens into all of these different areas.
Matthias, do you want to add to that?
Yes, I think what Ben said is absolutely right. I want to second that, but I think there's another element in terms of risk management, and that's what we see currently as the challenge for established financial institution. The risk management challenge with crypto assets is a different one compared to the new players, because the new players they deal with crypto assets like a means of payment. So it is anti-money laundering, KYC, which is important. But from a banking perspective, it's more than that. It's even kind of treated as a security. So customer protection is an element which needs to be taken into consideration when letting investors or clients invest. I think it's a different level of playing field. We heard that at the beginning, but as now regulation is evolving also for crypto assets and will mature over time, I believe that the ecosystem will consolidate. So the two types of assets will actually get the same regulatory scrutiny, and then the level playing field is the same.
We're down to 60 seconds. Pierre, anything quickly?
Yeah, just quickly. I think the technological change that we are seeing because people innovate in that space will lead to a significant increase in the number of and types of assets that we are seeing. And more regulators are adapting to that and are setting sort of principles rather than trying to regulate each individual asset separately. And I think that's going to be really useful in developing the space going forward.
Well, I'd have to say you all have, I think, ended on a relatively positive note, despite the complexities out there and the importance of regulation, but also the importance of getting it right so it doesn't stifle innovation. It sounds like the regulatory world and the innovators are trying to work together to identify the risks, to identify the challenges, while keeping the door open for the huge amount of work that really still needs to be done in terms of the financial system and the digital landscape that's developing. So thank you all so much for joining us today. This has been a great discussion, and we look forward to continuing it. Thank you.
Thank you.
Has
Thank you, everyone.